Now let us discuss the importance and advantages of using projected cash flow for decision making. When we move on to practical area, where we will prepare a projected cash flow and discuss how to take management decisions, I would suggest that you try to relate the discussions with these points. So we move on. Number 1. Predict cash shortages and surpluses. If we know when there is a chance of cash shortfall in next 12 months, we will plan for arrangement of funds beforehand. Similarly, if we foresee availability of funds, we may plan for an investment which was deferred earlier on due to cash shortage. Next, see and compare business receipts and payments for different periods against projections. Actual position is compared with projections to identify variances. Variances favoring business means that assumptions were correct, but in case of deficit variances, management checks whether its assumptions were correct or not. Number 2. Factors that led to such deficits. If the assumptions were correct. In this way, the business profits are easily safeguarded. Next is estimate effect of business changes. A company is on a growth pattern and need to expand its organization to meet its requirements. If the projected cash flow supports the growth and surplus funds are predicted, the management may hire new staff to meet its needs. Similarly, management may decide to open a new branch. In such case, the projected cash flow helps in making decision to arrange funds. Next, prove to lenders your ability to repay on time. In case a company plans to obtain loan from bank, or projected accounts are required to be submitted along with quotation or tenders, the projected cash flow assists such customers to assess the financial position of company and builds trust. Next, determine if you need to make adjustments. For instance, more rigorous follow-up of recovery against receivable, looking for alternate procurement resources with lower rates without compromising quality, cutting expenses, etc. Then last point is keep track of overdue balances. Management predicts that sales team will receive 70% of balances against monthly sales within 15 days. However, the sales team is able to recover only 68%, which seems to be nominal amount for 1 month. Management will only be able to see the real effect if the projections are compared with actual recoveries for a set of months. Our last point of today is we will discuss the broad structure of cash flow. Cash flow consists of 4 sections: opening balance, that is last period's closing balance, inflow, outflow, and closing balances, which is opening plus inflow minus outflow. Outflows represent funds utilized for acquisition of resources, mainly including material, manpower, utilities, other business related expenses, as well as capital expenditure. Inflows represent funds generated as a result of utilization of resources. As far as heads such as loans and advances, etc. are concerned, which supplement opening balances to ensure availability of funds and are repaid as per agreed terms, or sale of assets or profit on investments, etc. are concerned, they also form part of inflow or outflow as required, but mainly when we talk about inflows or outflows, they represent the business incomes and expenses. Thank you for now.